Hello everyone and welcome to Smart Money Source. This is going to be the first video of a series of videos where I'm going to be explaining all the knowledge I know about smart money and how to correctly apply a profitable strategy in the market and begin to start with. So in this very first video I'm going to be explaining the market structure. Hopefully you will get a better knowledge of what you can see in random videos in YouTube. My idea is for you to open your eyes in regard of what is actually happening behind the charts, behind each candle, what's the reason of prices moving, so you can have a deeper understanding of the market structure in this case, and follow the game along with what smart money is cooking behind the scene. So to begin with the basics about market structure, you probably already know that when we are on an uptrend, price is making a series of higher highs and higher lows that can be seen in a particular time frame. Okay, so what's special about these higher highs and higher lows that we see here? The special about this, the reason of why these higher lows are being created, is because smart money is actually accumulating orders when price is going lower and reaccumulating orders when price is going lower one more time. Why does price respect most of the time this low here? The reason is that if you are smart money and you have the power to control price, because you are either a big equity player, an institution, hedge funds, or a bank, if you have the power to manipulate price, you won't allow price to go underneath your own long orders. So if you have long orders opened here and price is approaching a level, because of even yourself, you as smart money could be edging your long here by shorting here, allowing price to go into a discount level of this range and then buying more here. So you won't allow price to go underneath because you don't want price to be, you don't want your own orders to be a break-even or even a drawdown. So when price is hitting this level, they will start a new campaign of accumulation to drive price higher. And that's what we see as a higher high. And what is actually a higher high? Why price is moving, making a higher high? The reason is that above each one of these highs, there is going to be liquidity that we are going to see in the next video. But the thing you need to know is above each high here, there is going to be enough liquidity for smart money to start either distributing the profits, meaning that they will close the profits from these longs, or they will start shorting on the market to either edge from the previous long here or to short to go even lower and reverse this current structure. So now that you have a grasp of why price is making higher highs and higher lows, you need to understand the following. What you see in one time frame, let's say this is the daily chart, okay, is not the same that you're going to see in a lower time frame. You will always have different trends inside of a bigger trend. So inside of this up move here, you probably have a lower time frame up move. Let's say this is the 1 hour chart inside of the daily chart, and you have this current trend like this. Let's change the color. So this orange trend line is from, not trend line, sorry, this orange uptrend is from the 1 hour chart. So what happens? When price is going down here on the daily chart to create the new higher low here, for price to go down here, what it needs to happen is that price needs to break this 1 hour structure lower to continue into a key level where smart money previously accumulated orders to then reverse again on the 1 hour and go higher. So as you can see, we have two types of moves depending on the point of view, which is very important. Point of view is extremely important for you to know what price is doing. So if we look at this 1 hour structure here, this orange move to the downside, we can clearly see that is, of course, a downtrend because price broke the structure to the downside and did a series of lower lows here lower highs, lower lows, lower highs. What happens? This is a downtrend, but in the daily chart, this is a retracement of an uptrend. So if you're taking a trade on this downtrend, you have to take into consideration that you're taking a trade based on a retracement. So how you can find the best setups, the one that has the most probability of winning? By following the bigger time frame structure. So if the bigger time frame structure is a daily chart, and you want to enter on that daily chart, you have to wait for this downtrend to finish. And a way of doing that I will explain later, probably on another video, is waiting for a break of market structure, a wake of accumulation, or other types of confirmation that price is likely to reverse to go higher. So once you get that, for example, this break of market structure that we are seeing here, once you get this type of confirmation, you can take a trade based on the origin of that break of market structure. If price made this move here, breaking this swing high, that means that smart money probably accumulated orders here on lower time frames to go higher. So when price, again, the same process that we are seeing here on a bigger scale on the daily, where price moves down to the previous higher low here, is the same thing we are seeing here on the 1 hour chart. So price comes back down, retraces, hits a key level here where smart money is willing to open new long orders and push price higher. So on top of that, you have to remember that every time price move has an objective, and that objective most of the time is liquidity. So if we know that I'm going to explain this on another video in depth, but for now, if we have equal highs, that is commonly seen as a resistance level, and smart money traders see this as liquidity level, and price is putting a series of higher highs and higher lows on the daily chart and is approaching this level, is very obvious or very likely that price will go after those equal highs to grab the liquidity above those levels. So until that level isn't hit or this target isn't met with price, then price will continue to go higher. It's likely, of course, we cannot say nothing is 100% on the market, but it's likely to go after the highs. So until that target is met, you can still look for buying opportunities over and over again. So what happens? This is theory, of course, this is theory. What happens in reality is that the chart won't move like this. It won't be as clean as this, and the reality is that something like this might happen. Yes, we are on an uptrend on the daily chart, okay? But inside of this uptrend, we will have something like this. All this structure on a daily candle maybe looks like a series of up candles closing like this, making this up move. And if we go to the lower time frame, again, this orange is representing the lower time frame, we might have something like this. And this on the daily chart is seen like this. So what I'm trying to say here is that when you are trying to use the market structure to trade, it's going to get very difficult because price will always be manipulating inside of the ranges. And a way to avoid that is by knowing how to read the liquidity, the retailer's liquidity, the institutional liquidity, and of course, if you know Wyckoff, even better. So the reason why I'm explaining this is because the market structure is only a framework to know where the market is likely to head to. It's only a framework where you can easily identify where smart money is putting their orders in order for price to continue going higher, and knowing why price is moving higher to target a point of liquidity. So we don't use the market structure to take trades. We use them to have a framework in order to take trades in the future. So now let's take a look at this last bit of price action here on gold. And I'm going to teach you now how I view the market structure in terms of break of market structure. So coming back to this example, every time price is moving higher or lower, we have breaks of market structure. And those breaks are very important because they are indicating that the trend is likely to reverse. So for example, here we were making a series of higher highs, higher lows, higher highs, higher lows, and then we had a lower low here. So this down move can be seen as a break of market structure here. So how we know if it is a break of market structure or only a stop hunt, which is a concept that we are going to see in further videos. So how to know? Well, there are different points of view. Some people use the wicks as a potential break of market structure. If price, for example, let's take a look here on real price action. If price, you can see here, is making a series of down moves, lower low, lower high, lower low. This is the 1 hour chart. Here price made an up move here, okay? So some people will use the body of the candle here to know if price broke the structure or not. In this case, if we look at the bodies of the candle, we can see here price didn't break the market structure with this wick here, but when price continued going higher, it finished and closed the bodies of the candle above that body. So some people might see this as a break of market structure. Some others might see only the wicks if it breaks the wick as a market structure. But now the question is, do we use the wick or do we use the body to know if price is breaking the structure? That's a very good question. This will come with experience, and in my experience, the best way to know if the market structure is broken or not, at least with a higher degree of success, is by using only the body. So if we have this wick here, we can only say that this downtrend is broken once we have a full body closing above this wick. And if we go to the right, we can see that that happens here. We have a full body closing above this high. So this is considered a break of market structure. So if we were on a downtrend and now we have broken the structure to the upside, what is going to happen? We're going to have a higher low. Why? Because we just made a higher high. And if we look at the origin of this up move here that broke the structure, we can clearly see that it's either this down move where smart money accumulated orders or this down move where smart money accumulated orders. So after breaking the structure, we expect a down move, a retracement, to make a higher low. You can see that price made a higher low here. So now, if this is a valid break of market structure, and this is a very important thing to always have in mind, if this is a valid break of market structure, price should make a higher low here and a higher high again. If it fails to make a higher high, it means that it's failing to continue this break of market structure. So if we look at price action here on gold, we can see that price made a higher high, but when it tried to push higher, we can see we have a lot of indecision here and probably a lower time frame distribution schematic. We can clearly see it here. And price is failing to do what it's supposed to do. What is market supposed to do? Make a higher high, because it just broke a bearish downtrend. So now that it broke it, it should continue an uptrend, but it's failing to do so. So if it is failing to do so, what is going to do? Exactly the opposite. It should go after now this low here. Because if it fails to go higher, then the only other option is go lower. As simple as that. So if we were watching this and we let's say we took a trade here, we open a long here and we are in profit. If price is approaching this level and we want to take profit above this high because we expect for price to make a higher high and it's failing to do so, then we have to be very careful because price might actually reverse, which is what's happening here. And look what happens here. We have a down move. Did this down move went lower? Yes, it went lower than this previous low. But did it break the structure? Well, if we take into consideration only the wick, yes, it did break the structure because price made a lower low. We can clearly see that here, a lower low. But if we look at the bodies of the candle, price didn't break the structure. So this moved down here. What is this? Why price came lower? Because it's grabbing liquidity below this low. Remember, this impulse up was originated on this low. So this was the last lower low, or the last low that originated our new higher high. So unless this is broken, okay, we cannot say that we are on a bearish trend. So this needs to be broken in order to call this a break of market structure to the downside again. So this is very important, because let's now label all these. We have a lower high here. This is a lower low. Now this is a higher high. And the question is this a lower high here? And is this a downtrend? No. The only way we can call this a lower high is if price indeed breaks the structure. If it does break the structure, then we can call this a lower high. So going back to the drawings that I love a lot, we have a higher low, higher high, higher low, higher high, higher low. Is this a higher low? No. The only way we can call this a higher low, a valid high low, is if price breaks the structure again to the upside. If it does, then yes, it's a higher low that we can take into consideration for the next move down. We know that if price breaks this low, then we are in a bearish situation. But if it doesn't break, we are still on a bullish situation. This gets confusing when price starts doing something like this. We have made a higher high, price make a quote-unquote higher low, fails to break the structure, and when price is returning, we see this as a valid higher low where we might take a trade, but we are wrong because price didn't break the structure on this up move. So this is not a higher low, this is a liquidity point. So price, what it will likely going to do is take that liquidity out, come into the real higher low, which was this one. So the real higher low is the last move down that created our last higher high. In this case, this move down created this move up. This move down didn't create a higher high, so we cannot say that this is a higher low. After grabbing the liquidity, probably price might continue going higher. So coming back to this case, this is not a break of market structure because the bodies of the candle didn't close below this level right here. Okay, so this is still a quote-unquote bullish trend. Using Wyckoff, you will probably know that this is a redistribution schematic. Okay, that's okay. We can clearly see here now we did have a break of market structure using the bodies of the candles. So what can we expect that we had a break of market structure on gold on this time frame? We can expect a pullback or a lower high. So which was the last lower high that created our lower low here? Well, the last lower high that created our lower low was this one. It wasn't this one, wasn't this one, wasn't this one, was this one right here. This is the last lower high, the failed higher high, the shift in market structure, if you want. Price is failing to break the structure one more time, so it's going lower. This is the real deal. So inside of this consolidation area is where Smart Money probably distributed short orders or open short orders to go lower. So what can we expect from price now? We can expect price to come back, create our lower high, and then continue going lower. Okay. So another thing I want to mention about market structure is that the higher time frame is always most important. Higher time frame is always more important. So don't lose yourself on looking at the lower time frame only, or looking at even one time frame or two time frame, three time frame. Always take into consideration if price is reaching a higher time frame key level. If we are on a monthly chart, for example, we are making a higher high, higher low, and higher high on the monthly chart. You have to understand that if price is down here on the monthly chart, and we have, let's say, a target to be met, an old high here with buy stops above the high, liquidity. Again, I'm going to explain this on further videos. But let's say price still has reasons to go higher. So we might miss the opportunity to buy here because we are very concentrated on the daily chart or on the weekly chart. So it depends on what type of trader you are. You're a scalper, intraday, swing trader, position trader. You will see different time frames. But it doesn't matter what type of trader you are. If price is about to hit a key level on the higher time frame, you have to always know that. You cannot avoid knowing that fact, because it will get you in a very good trade, you will miss a very good trade, or you will get into a very bad trade. Okay, so it doesn't matter if you're a scalper, because if you're a scalper and price is hitting a monthly level here, you will see a very big reaction to the upside or to the downside, and if you didn't see the monthly chart, you will miss it, or you get in the wrong trade and lose a lot of money, or the worst case scenario, you will get slippage and your stop loss won't trigger, because that happens as well. When there is a lack of liquidity, when the market is moving very fast, slippage might occur, and it happens on every broker. So what I'm trying to say here is that once you understand market structure and all the things I'm going to teach about smart money, it's very important for you to mark each key level that you see on the chart, from the monthly down to whatever time frame you're trading. So if price is about to hit a monthly level, you will be extra cautious with trying to scalp that level, because you know that that level might end up in a massive explosion to the upside if we are on an uptrend. So if price is going down here and you're on a downtrend, you're trying to catch each one of these moves to the downside, but price is about to hit a key monthly level, the weekly might see bearish, the daily might see bearish. Every time frame below the monthly chart will be bearish, and it will look very bearish, and the sentiment will be bearish as well. So you will get into that bearish position without knowing that a sudden move to the upside might occur very soon. So that happens when you are scalping and we are hitting a daily level, 4-hour level, weekly level, and monthly level, and even higher, quarterly level. That's also important. So every time you are about to enter or try to look at the market, always take into account if price is near a key level on a much higher time frame. Only in that occasion. You don't need to mark every level every time you're going to trade. Only if price is near a key level, you have to know beforehand, so you can anticipate for any possible move that will take you out of the trade or make you a lot of money. So that's all for this video on market structure. It is to give a little bit of light to those traders who have been scammed by these fake gurus, this lack of valuable information that it's all over the internet is what makes people lose money and lose time. So I hope this series of videos I'm going to be posting are the first step to abandon the retail world and join the smart money world, where the profitability will allow you to be a trader or trading for a living. So if you liked it, please consider subscribing and giving a like. See you in the next video.